Welcome to the InterMarket Analysis video update. This is a video that I do once a week where we look outside of the S&P 500. We check out other stock indexes. We look at other stock sectors. We also look at other markets because no market exists in a vacuum. And sometimes we can get some clues to what's happening in the S&P 500 by looking outside and then seeing what kind of an impact that has either in a positive or a negative way. This is being prepared for Monday, November 27th. The first area that we look at is S&P 500 valuation. We look back at earnings that have already been released and how do they relate to stock prices. We look forward based on analyst projections and forecasts because that's what the stock market uses to justify prices going up or down. And then we take that and look at it right now to see what kind of an evaluation can we make. The first area looks backwards at a thing called TTM, or the trailing 12 months. And we can see over a period of time that there are static numbers that are used. When we get a PE ratio of 10 or below, the market is considered to be inexpensive or cheap. Between 11 and 19, the market is fairly priced. And when we get 20 or above for the value, the market is considered to be expensive. So we look at the current price of the S&P and compare it with the PE ratio of 20, and you notice that we are well above that level. So on a historical basis, we are considered to be expensive. But this can last for a long period of time. We don't use this as a timing mechanism. We don't necessarily make shorter term decisions based on this, but we just want to be aware of this. And then on the bottom is the spread between the price of the S&P right now and the PE ratio of 20. When it's above 0, that means we are expensive. Then we can also look at this in the context of historical events that have happened in the market. Here's the 87 crash, the dot-com boom and bust, the housing crisis, and then way up on the right-hand side, that's where we're at right now. There's also another way of looking at historical data called the Shiller PE ratio. You may also know this as CAPE, C-A-P-E, developed by Robert Shiller. Right now, we're coming in with a reading of 30.86. To give us some context, we have a historical chart here, and we also have the median and the mean between 16 and 17. Well, we're coming in at 30.86, so this is also suggesting that on a historical basis, the market is considered to be expensive. But the market doesn't do that. They look forward. And so we have some forward-looking PE ratios. These are based on, as I said before, analyst projections and forecasts, and they are then intermingled into the market, and then people buy or sell based on what they think is going to happen going forward. Right now, we're getting a forward-looking PE ratio for the S&P 500 of 18.8. So we're below that 20 level, but we're above the 15 level. When we look at the mid caps to get some more comparison, we're at 13.5. We're below the 15 level. And in last place right now is the small cap index, which is at 12.9. It's above that 10 level, but still below the 15 level. We can plot all of these together on a chart, and they have a tendency to move in the same direction. They're in different colors to kind of differentiate between them. And we've been going back up lately with the PE ratio as stocks have been going up. When we look at the small caps, there are two different ways to look at this. There's the S&P way, which is the S&P 600. That's the area here in blue. And there's the Russell 2000 index, which is a very popular index. That's in red, and they're on different scales. I tend to use the blue one because they line up with the 10, 15, 20 scale that we use. But I also follow the Russell 2000 because it's very popular and we can get some insight from that. But you can't really make an exact comparison when looking at valuation. We also look at growth to value. Growth is when you want to buy low and sell high. Value is when maybe you're looking for dividends, or maybe when the market runs into some difficulties. These stocks tend to hang in there a little bit better, and we can make some comparisons. First of all, we look at just growth, and we see that it is in a downtrend, even though it's been bouncing back up since the latter part of October into November. We also look at just value, which has also been bouncing back up, but still is in a longer-term downtrend. Where it gets interesting is when we can compare the two with each other, and we look at a growth to value ratio on the top, showing the growth is outperforming, And then we have an inverse of that below showing how value is underperforming. The reason why I have a number of different studies on here is sometimes we look at indexes, sometimes we're looking at sectors, sometimes we're looking at ETFs, and we can get slightly different results based on what we're looking at. You can see an example right here is we see a difference where the moving average crossed over, not by very long, but when you're making some major decisions and you want to grow from value into growth, you want to be seeing a lot of confirmation of that. We also look at an ETF of growth to value, showing how growth is outperforming value. Here's an inverse showing how value is underperforming growth. We look at another growth index showing how growth is outperforming. And then we also look at how value is underperforming growth here in another measure. And we look at it in slightly different ways because this gives us a little bit different perspective. And sometimes we can get some insight from this. Then we look at a growth index versus a value index showing how growth is outperforming. Here's another way of looking at it using a rainbow chart showing how growth is outperforming value and how value is underperforming growth. We look at the small caps and we look at the growth to value ratio here. And I show this quite often in the daily videos where we've been going more or less sideways, but we have been holding up even as the index had been going down. We also look at mid-cap growth to value where it's showing a little bit more strength, even though it's been chopping sideways as well. When the index itself was under pressure, this was still hanging in there. That could be longer term positive. We look at the S&P 500 growth to value ratio where it's been chopping sideways and actually showing a little bit of weakness now. As the S&P has been going up, we're not seeing this ratio really going up. That's a little bit of a warning sign. We keep an eye on inflation. We have a monthly chart of the CRB, which are commodities. And even though this is coming down, we're still right about at the moving average, and it's been chopping sideways in the longer term. Then below, we have a ratio between inflationary aspects of the CRB index and deflationary aspects of the CRB index. When this is going down, that means that inflation is not happening. In fact, deflation is happening. That means that overall prices are declining. That can be seen as positive, but if this really continues to fall, deflation is actually worse than inflation. So the market keeps a close eye on this, but it's not necessarily running into a problem, at least yet. We look at the CRB index, which is still in a longer term uptrend, even though it's been seeing some weakness and chopping sideways for the last few months. We look at the Baltic Dry Index, and some people shift this around and compare it with indexes. I just look at it for what it is. This is what does it cost to ship products from point A to point B, specifically in the Baltics. When this is going up, that means that this index is going up, which probably means their prices are going up as well. And so we are seeing this ticking up, which could be a little bit of a concern, but we have really spiked up a lot higher than this before. We look at some other markets, such as aluminum. It's continuing to be in a downtrend, and corn is also in a downtrend. Wheat is in a downtrend. We look at fertilizer, which is rolling back over and starting to go down. Oil is also chopping around quite a bit. It was really spiking up as geopolitical events were unfolding in Israel. Now that things seem to be calming down, they're not really calming down, but it's not becoming at the forefront of every news cycle right now. We're seeing oil dropping back down. And so even though it's in a longer term uptrend, it's still showing some recent decreases. We keep an eye on gas, which is in a longer-term downtrend now, and that's probably more helpful whenever you fill up your car or truck. We keep an eye on diesel. It's starting to go back down as well. This is for 18-wheelers and trains. They use this as fuel to transport products. Heating oil, even though it's getting colder, it has been starting to drop back down. Natural gas has been chopping back higher, but then we're seeing it pull back just a little bit. And it's still in it's actually still in an uptrend here. Copper, which is a barometer of the economy, when copper's going up, that tends to mean a stronger economy going forward. When it's going down, the market is suggesting the economy might be weaker going forward. And we have been in a downtrend, but we did see a little bit of a bounce here recently. And we look at the copper to gold ratio. When copper's looking good, that's good economics. When things are really unsettled and there's a lot of fear in the markets, that's when gold tends to outperform. And near the middle to end part of October, we saw gold really starting to outperform. I'm sorry, should be going down. We saw gold really outperforming. So this ratio was going down. Then we saw copper start to come back and look a little bit more positive, and so that is when this ratio is going up. We then have a longer term look at this same chart. The copper to gold ratio is in black. We also plot the 2-year yield and the 10-year yield, and they're quite far apart from each other. It's been that way now for a couple of years. Usually we'll see them going in the same general direction, and we see them not get very far apart from each other, even though they're on different scales. This could suggest that the economy is going through a longer change in character. We keep an eye on gold, which it really went up as things were unfolding in Israel. It then pulled back. It's still in a longer term uptrend and has been bouncing back up, but it's not breaking out the way a lot of gold folks think it should be. Silver is also in a longer term downtrend. It bounced up because it's a precious metal as well and has been showing a little bit of an improvement lately. We look at gold on the top. These are just end of day values, and then silver in the middle, and we look at the correlation between the two. Now, they both could be going up or down, but this suggests that they tend to go in the same direction at the same time. Then we take some general observations. We have a growth to silver ratio on top. When this is going up, gold is outperforming. When this is going down, silver is outperforming. And then we look at the US dollar index, and we can take away some useful insight here. When the dollar index is going up, gold has a tendency to outperform silver. You see how this ratio is going up as the dollar has been going up? Now, both gold and silver could be going up. It just means gold is doing better. And then when this ratio is going down, that means that silver is outperforming gold. And we see down at the bottom where the correlation between the top chart and the middle chart are quite strong with each other. So if one is moving up or down, you can put a little bit of confidence in that. We look at the dollar on the daily chart where it's really been strong lately, but now has been pulling back even though it's still in an uptrend. We look at the euro, which has been bouncing back up against the dollar, where the dollar's been going down as the euro's been going up. And we also keep an eye on the Japanese yen, which continues to decline when compared to the dollar. And then I have some breakout charts. Here's the euro to the dollar, which is still in a longer term downtrend, but the euro's been starting to bounce back up. The Japanese yen continues to be underperforming the dollar, and the British pound. It's been chopping around a little bit. We do have a death cross here, but the British pound has been starting to outperform the dollar as we've been seeing some weakness over the past week or so. We keep an eye on some other indexes, and I show this in every daily video where the equal weight index is the red line, and that treats all stocks in the S&P equal, where the S&P 500 is a weighted index. And when the red line is underneath the black bar chart, that means that the broader market is underperforming. When we can turn more positive is when this red line actually goes above the bar chart. But the fact that they're both improving is encouraging. But to see more of this broad-based, we want to see the red line begin to outperform. We look at a ratio between the S&P 500, which are stocks, and the CRB index, which is commodities or are commodities, and it's showing that stocks are outperforming recently, but we did see a death cross with this ratio. And here's an inverse of that, where we saw commodities starting to outperform, but now have been underperforming in the shorter term. We look at the NASDAQ 100 and the S&P 500, and they both have had really good years in 2023, but the NASDAQ 100 is performing even better. We look at the S&P 100, which is still outperforming the rest of the S&P 500. We look at a ratio between the NASDAQ and the S&P 500. Both have done well, but the NASDAQ itself is doing even better. We look at the NASDAQ 100, which has been doing really well. Those are the big mega caps, and the NASDAQ, which is the rest of the stocks, and the NASDAQ 100 is outperforming. We look at the mega caps, the really, really big companies, and compare it with the equal weight index, showing that the mega caps are still outperforming. We look at a ratio between the small caps and the S&P. That's the red line. This continues to go down. That's a bit of a warning sign. We want to see this red line going up, and the blue line, which is the S&P. If that's going up, then we can have more confidence that things are looking more positive. We look at a ratio between the small caps and the S&P, showing how the small caps continue to underperform. We look at the biggest software companies, where they started to show some weakness, and we saw a death cross here, but lately they have been bouncing back. The mega caps, these are the really big companies. They continue to really perform well and are in a pretty solid uptrend. The robotics and AI ETF is starting to show some improvement, coming back up into the rainbow. And it has been really underperforming the tech sector, even though it's been bouncing up and possibly showing some improvement. The Dow Jones Composite Average takes the Dow, the transports, and utilities and puts them together into one composite average. We've been chopping more or less sideways. And while we were going sideways, we were in an uptrend. Well, now we saw a recent death cross, but now we're seeing this coming back up. And so eventually we might see another golden cross here if we continue to see improvement. We look at the S&P 500 and compare it with shorter term bonds, showing that stocks are outperforming shorter term bonds. We look at the broad market with further out bonds, showing that stocks are outperforming bonds. We look at the low volatility ETF, which is going pretty much sideways, but still is in a longer term downtrend. We look at a ratio between low volatility stocks and the S&P and shows that the low volatility stocks continue to underperform. We look at the tech sector and compare it with 3 to 7 year bonds, showing how tech stocks are outperforming. Then we look at some other stocks. We have an advanced decline line studies, and I usually show this in the daily video. If nothing's really happening, I don't. But we are seeing some improvement with the NYSE common stock measure. We're going above the moving average. However, the moving average is still going down. If we can stay above this, that would turn the moving average back up. We are seeing some improvement with the S&P and the mid caps. Finally, we're seeing the small caps starting to cross back above the moving average. The longer they can stay above this, the more this moving average will turn up. We look at traditional Dow theory, where the Dow's been doing pretty well lately, but the transports are underperforming. They're going up, but they're not really outperforming the Dow. And the utilities, which had been really weak, they're starting to show some improvement. We look at a ratio between the transports and the S&P. In a more solid environment, we want to see this ratio really going up. It's actually chopping sideways. We look at a ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming, and that's really what we're seeing right now. We want to see this ratio going down, suggesting that the transports are outperforming, and we're just not seeing that yet. We look at the relationship between the S&P and the transports, showing that they have a fairly strong correlated relationship. We look at a new way of taking Dow theory, and instead of using the Dow, we use the S&P. Instead of using the transports, we look at the NASDAQ, and these are pretty much confirming each other right now. We're not seeing any real divergences that we need to be aware of. The FANG index, which are the really big mega cap stocks like Facebook, Amazon, Apple, Netflix, Google, and some others, we might be getting a little exhausted here. We're starting to set new intraday all-time highs. We're above the 50-day moving average, and we're still in a longer-term uptrend. We want to keep an eye on this because this could really help the market go higher if we continue to see strength here. Then longer term, we came back up and we actually surpassed the all-time high, but we did not close above that. Is this going to present some kind of a problem? But for right now, we're looking pretty positive here. ARK is showing some improvement, even though it's still in a longer-term downtrend. And we look at a monthly chart of the S&P 500 showing that it's above the moving average. And we do a ratio between the S&P 500 and stocks in Europe, Australia, Asia, and the Far East. And it does show that U.S. stocks are outperforming and the overall momentum is also positive. We keep an eye on bonds, where based on price, they continue to be in a downtrend, even though they have been bouncing back up. We look at a world bond index, also in a downtrend, but showing some recent improvement. We look at a stock to bond ratio on a monthly chart showing how stocks are outperforming bonds. This is a shorter term look showing the bonds are underperforming stocks. Then we look at high yield corporate bonds, which means junk bonds, and they tend to follow more what happens in the stock market. These are pretty risky, but folks like these because they give a good return and they continue to be in an uptrend. Investment grade bonds are more conservative, don't give as high of a return, and they continue to be in a downtrend, even though they have been bouncing back. We look at the ratio between risky bonds like junk bonds and more conservative bonds like government bonds, and the riskier bonds continue to outperform. We look at a ratio between stocks and bonds, and they're having a fairly strong correlated relationship. So if you look at the market one day and the S&P is up, right now anyway, bonds are probably up. If the S&P is down, bonds are probably down. We look at the corporate bond index, which is showing more of a recent death cross here and a downtrend, but this has also been showing some even shorter term improvement. We look at the 10-year yield where we're still above this 100% retracement level. We got up to 5%, and since then we've been falling back. We also look at a longer term chart of the 10-year treasury yield. This goes back 40 years. For a long time, we were seeing a series of lower highs and lower lows as interest rates kept going down and down and down. Well, we're wondering, are we shifting to a new environment now as interest rates start to go back up? We look at the 30-year yield just to see where it's at these days. The benchmark for the US is pretty much the 10-year, but this is a longer term bond, so we just want to keep an eye on this rate. We look at the S&P 500 and take a ratio between it and the 10-year treasury yield, where the S&P was really underperforming, but as the bond market was under pressure and stocks have been showing a bounce, we've been seeing stocks really improving, even though they're still in a longer-term downtrend. Here's the junk bond ETF showing that junk bonds remain strong. We look at a ratio between junk bonds and government bonds, showing how government bonds are outperforming. We look at, and I show this in pretty much every daily video. This is a daily chart of the 7 to 10-year bond ETF, where it's been under a lot of weakness. We're working off of a death cross, but the RSI, even though it's declining, is still above 50. Shorter term, we're seeing a positive momentum with the MACD. We look at a daily chart of the yields across all the different maturities, where interest rates had been going up. Lately, they seem to be coming down. Then we look internationally, where the US and UK have the highest rates, followed by Germany, and then Japanese rates are in red. And for the most part, rates have been coming down lately. We track the volatility of bonds, and that's the MOVE index. And we also track the volatility of stocks. That's the VIX index. And they have a pretty strong correlated relationship right now. So if stocks are really gyrating, that might mean that bonds are really gyrating as well. Then we look at a monthly chart of the price of the 30-year bond, where it continues to be in a downtrend and is underneath a declining moving average. And then on the bottom, we have a ratio between the long-term bond based on price and the CRB. This is showing the bonds are outperforming, but this is starting to roll over, and it can take a long time for this chart to change. We look at different sectors. The materials are really underperforming the S&P. Communication, one of the stronger areas in 2023, it continues to outperform. The energy sector was making a comeback, actually enough to generate a golden cross, but now we're seeing some weakness compared to the S&P. Financials, which really took a dump back in March, have pretty much been going sideways and are still in a downtrend. Industrials are also in a downtrend. The tech sector is in an uptrend. The staples, which were strong in 2022, they've been a lot weaker in 2023. And real estate continues to be in a downtrend. It's trying to bounce back up a little bit, but it's got a lot of repairing to do. Utilities are also in a longer-term downtrend. And the S&P to utilities ratio, when this is going up, that means the S&P is outperforming utilities, and quite often we see the S&P going higher. When this is going down, that means utilities are outperforming the S&P, and quite often that's when we see weakness in the S&P. We also look at healthcare, which is underperforming the S&P, and here's another chart showing that it's in a longer-term downtrend. We look at discretionary, which has been chopping sideways compared to the S&P. We want to see some more strength from this, and we're just not really seeing that yet. It's not falling apart, but it's not showing a lot of strength either. The staple sector, which was better in 2022, even though it was pretty choppy, it went down, but maybe not down as much as some of the other growth areas. Well, it's now underperforming in 2023, but it has been bouncing back lately. We look at the tech sector, which is in a pretty solid uptrend. And we look at the semiconductors, which are also coming back and could be testing this previous high. And then way back here, we have the all-time high for this particular index, but they're still looking fairly strong right now. The tech to S&P ratio shows that tech is outperforming the S&P. Energy, which was trying to bounce back up, is underperforming when compared to tech. Growth is outperforming bonds, and that just is more indicative of a more positive environment. The tech sector is starting to show some improvement here when compared to the rise in interest rates, even though we're working off of a recent death cross. Here's an inverse of that same chart showing how the rise in interest rates were actually going up more than tech stocks, but now that's starting to come back down. We look at a ratio between discretionary and staples, showing how discretionary is outperforming. But we want to see discretionary get even stronger if we're going to turn more positive. Here's the inverse of that same chart showing how staples are underperforming discretionary. Here's the ratio between gold and the S&P, where it's been really choppy lately. Gold really spiked up when everything started to explode in Israel. Now that it's not in the main forefront of the news cycle, we're seeing this ratio coming back down. Gold is also underperforming the dollar, even though the dollar has seen some weakness. We've seen a little bit of bounce in this ratio, but it's not really breaking out yet. High leverage loans, these continue to be strong. And if we're looking like the economy is going to run into some real difficult times, this would not be going up the way it is right now. The NYSE composite is still in a longer term downtrend. It's been chopping sideways and showing some improvement. That's a broader measure. Then we look at all stocks, which also had some weakness. They're starting to bounce back up. They may salvage this golden cross. Emerging markets are pretty much chopping sideways, continue to be in a downtrend, but have been bouncing up recently. The micro caps, which fell under 100 and were setting new 52-week lows, well, lately they're bouncing back up. We're above 100 now. And we look at the home builders. We have the S&P on top, then the home builders ETF. Here's the ratio between the two. And what we're looking for is when we get down into this dashed line area where I have it marked in yellow, right now it's just showing that the S&P and home builders are having a strong correlated relationship. So it's not really giving us any concern. We look at Bitcoin just to keep an eye on this. We did see a recent golden cross. We've been going up a little bit higher as Bitcoin has enjoyed some positive seasonality. And then we look internationally, and this is a longer-term momentum study using the KST, where China, emerging markets, Europe, and Japan, as well as the US, across the globe now, we're looking more positive. Then we look at an intermarket analysis chart going back to the beginning of the year. Stocks are doing the best, followed by gold, the dollar, and oil, where bonds based on price are negative. They slipped into negative territory last August. We look at some correlations. We look at the S&P 500 and compare it to the US dollar index, where they're having a pretty strong inverse relationship. So if stocks are going up, the dollar's going down and vice versa. We look at the correlation between the S&P 500 and oil. Their relationship is pretty neutral right now. And we look at the S&P to the 10-year yield, also going in opposite directions. If interest rates are up, stocks are probably down and vice versa. The tech sector to the 10-year yield also in opposite directions. And then we look at the S&P to the shorter term 2-year yield. They're having a fairly strong tendency to go in opposite directions. Then we look at some long-term charts. This is a monthly chart of the NYSE. The NYSE is a broader measure where it's coming back above the moving average. So that's longer-term positive. When we look at the Kopic curve, which is a momentum oscillator, that is also starting to show some improvement. We look at a daily chart of the NYSE, and we look at the NYSE record high percent index. It had been going up, and then we saw some weakness throughout the summer, and now it's starting to turn and go back up. We look at a monthly chart of the S&P on top, which is it's still above its moving average. And then we look at the momentum where it had been showing some weakness, and now it's starting to show some improvement here. Then we look at a ratio between the S&P and the CRB index, where stocks continue to outperform the S&P. Then we look at another measure of the S&P 500 on a monthly chart and compare it with global stocks. We are going up, showing the S&P is outperforming. The KST is still negative, but it is showing some improvement and could be crossing soon. But since this is a monthly chart, it can take a long time for this to happen. Then at the end of this video, I look at all the different things and I measure what is positive and what is negative. My definition of positive is when the 50-day simple moving average is above the 200-day simple moving average. So we have the CRB index, the dollar, mega caps, the FANG index, bonds, both the high yield and junk bonds, the tech sector and semiconductors, high leverage loans, the Dow, which did generate a death cross, but that didn't last very long, and now it's starting to turn back up. The NASDAQ and NASDAQ 100 are positive, all stocks, and Bitcoin is continuing to be positive. Then my definition of negative as it applies to this video is when the 50-day simple moving average drops below the 200-day simple moving average. The growth indexes are negative, as are the value indexes and ETFs. It's just when you compare the two, growth is outperforming value. Gold and silver are also in longer-term downtrends, as is copper. And then the Japanese yen, the euro, and the British pound. Even though they're bouncing back against the dollar, they're still in longer-term downtrends. The big software companies, they're showing some improvement, but still in a downtrend. The Dow Jones Composite Average, which has really been chopping sideways. The low volatility ETF, ARK, is still in a downtrend. The NYSE Composite, Staples, the Total Bond ETF, World Bonds, mid caps, small caps, and micro caps. And then emerging markets also are continuing to be negative. So thank you. I hope you found this helpful. Please feel free to check out the daily videos, the weekly video, and then this intermarket analysis video. Of course, if you're listening to this, you've already checked it out, unless you scroll to the end. After this, I will be preparing the deep dive video, which is where I look at all the daily charts and put those into a video, because maybe we're missing some insights that we might get from those charts. Have a very good weekend, and I will talk to you in the next video.